Ladies and gentlemen, I just came across a clip from Tom Lee today on CNBC that I think you really need to hear. He resonates with a lot of what I have said. I almost agree, 100% with everything he says because it's a lot of the same things that I have been saying. And I think he's ahead of Wall Street, right? As I've said on this channel many times before, the best investors need to see the future in some degree. You don't have to see all the future, but if you can look into the future and accurately predict what is going to come next, you are going to make a lot of money over your lifetime, okay? Any billionaire investor, that is always what they have done, okay? Now, beyond that, I think what Tom Lee says here in this clip and what we're going to talk about in this video is especially bullish for a stock like Tesla. Because, what Tom Lee is saying, what I've been saying specifically around the markets, not Tesla, is a pretty damn bullish backdrop. But you have all of these other things happening with the Tesla story. Mix the two together, and I think it's very hard to be bearish on Tesla. I think you're really reaching if you're a Tesla bear right now. And I think Tesla is going to be a $600+ stock by the end of this year. Tesla could have a $2 trillion valuation by December 31st, 2025, which would be around $640 or so for Tesla stock. And I will discuss why that is more in depth after this clip from Tom Lee. Ladies and gentlemen, hit that like button and subscribe to the channel if you have not done so already to get insight and perspective on Tesla and on markets that you simply cannot find anywhere else. Nobody does it like we do it here on this channel, for better or for worse.
Today's pullback comes after a standout week for the bulls, of course, which saw the S&P jump more than 5%. Joining us here at Post 9 is Tom Lee, Fundstrat Global Advisors Head of Research and Fundstrat Capital CIO. Happy Monday, Tom. Good to see you in.
Yeah, happy Monday.
You really haven't been unnerved by anything since Friday night, have you?
No. I don't know if there's much signal in the downgrade Friday because I think the first AAA downgrade was signal from 2011. I don't think Moody's had any information that we didn't have on Friday afternoon. So I think markets should realize the bond market largely priced in the fact that the U.S. is really not AAA anymore. So I'd be viewing this as a buying opportunity.
That said, you're not discounting the notion that the vigilantes have been reawakened a bit?
I think everyone should be aware the U.S. has an unsustainable path for debt, but I think the real signal will be when an auction fails. That happened a few years ago, and then we realized that was the time to really pay attention to the fact that we have debt sustainability issues. But I think a downgrade itself, I don't think it makes this much signal.
So we reclaim the 200-day. Is that a clear path to a new high, as some of the trading desks suggested this morning?
Yeah, in fact, I think today will be an interesting test. I'm assuming today's pullback's going to be really shallow, might even close positive, because most investors rage sold at the bottom in April, and then they doubted.
I hadn't heard that.
Yeah,
that's a good one. Is that your own, or have you heard that other places?
I've heard that. Yeah,
rage sold.
Yeah.
Sorry, go ahead. Continue.
And so as the markets climbed, a lot of people sort of doubted, thought it was a rally that would fail, and so I think there's $7 trillion cash on the sidelines, enormous skepticism from our institutional clients, and a lot of folks sort of bet outside the U.S., so I think there's going to be a lot of chasing into year-end.
Although, a lot of shorts have been covered already, though. A lot of the hedge fund guys who actually got it wrong and rage sold, to your point, are in a very different position right now in terms of positioning.
Yes. No, and there's a difference between being short and versus having positive beta to risk assets. So I think most people might be flat on their books, but if the market is above its 200-day, showing this sort of impulsive buying, and you're flat, that means you're underinvested.
How are you evaluating potential changes in tax policy? Obviously, the market has been very reactive to any headlines on tariffs. What about this one?
Yeah, in fact, I think as we start to think about 2026, and it makes sense because we're in the mid-year, there is not only tax policy that can be a tailwind, it looks like it's going to be, but it's deregulation.
Sure.
I mean, several published pieces show that regulatory cost for U.S. companies is over $2 trillion, maybe as much as $3 trillion. It's a bigger deal than the tax cuts itself.
Yeah, obviously we've been waiting for some time about the regulation. So in this environment, the ever bullish Tom Lee, what are you looking at when it comes specifically to the Magnificent Seven? We watch those so carefully, but the Nasdaq, of course, under pressure here today.
We think the Mag 7 is going to lead into year end because it's a group that fell first. It was widely owned, but it really got washed out. I think Tesla was a really good sort of case study. So I think the Mag 7 is going to reclaim its old highs. That's, of course, why the S&P should regain its old highs and of course, actually move above that before year end.
And what about financials? That's obviously an area that so many people were looking to early on. Is that still on your radar?
Yeah, financials are important. You need the banks to rally. They have been. If I was going to make a case for multiples expanding, financials is one place because not only did they prove themselves actually pretty resilient during Fed hikes and during this turmoil, but they're kind of more tech-intensive companies with better credit profiles. So I think multiples should go up.
If we do revisit the highs, what needs to happen to push past that? I mean, how firm of resistance will it be?
Well, I think investors have to look past tariffs because if we're only trading tariff headlines, the markets are going to be range-bound. But again, as I look at 2026, I'm looking at companies that are battle-tested. They survive the tariff headlines. There might be freer trade. That's an upside to earnings.
Freer trade than we thought.
Yes, than we thought, yes.
But earnings estimates have come down, have they not?
Yeah, but they're going to flex in both directions, meaning I think if we have deregulation, possible improved ability to export, tax cuts, that actually all supports higher earnings. But I also think the multiple for the S&P should be going up because, again, we've taken away a black swan event. I mean, we did, the February to April period was a black swan for stocks.
Do you think the downgrade hurts the push for tax cuts?
I think it's going to have almost no effect.
No effect?
Yeah, because at the end of the day, the bond market prices what they think the rating should be.
I don't mean from the market standpoint. I mean from the political optics standpoint.
Yeah, it might, but at the end of the day, the U.S. really wasn't AAA anymore because it was only 1 out of 3, so it's like not even a split rating, AAA.
So, Tom, is there anything out there? I mean, and to be fair, you've been bullish throughout. You were right during this period when a lot of others sort of, whether they rage sold or just got upset in general. But what, if anything, is top of mind for you in terms of a concern?
Well, I think the most important is the consumer has to stay healthy because right now we're seeing this huge divergence, right? Like the UMich surveys show banana-level inflation expectations, but the realized is low. If the consumer gets super cautious and retraces, then we have a recession. So I think it does come into consumers have to stay confident and keep their jobs.
And so you're a believer in the data versus the sentiment?
Yeah, at the moment, this divergence between inflation and realized is actually the largest, I think, ever recorded for UMich. And so I would say as long as inflation doesn't explode, then the consumer has marginally a chance to become even more positive.
Wow.
Yeah, a lot of your former colleagues at JPM think that the hard data will catch up to the survey work.
Yes. And I'm paying attention because, of course, JP Morgan, they do a lot of homework and they've got credit card data, so we do have to watch it. Sure. So we just have to hope for the best.
Tom, always. Good to see you. Thanks.
So, again, I think all of that was hopefully insightful to you. And I think Tom Lee's correct. If we're just trading the tariff headlines, we're going to stay in a range. But inevitably, I think we're going to break out of these new all-time highs and probably see a 20% rally into year end. Okay. I know that's crazy. Even Tom Lee would probably call that crazy at this point or far-fetched. But I don't believe we're going to see inflation. I believe in my core as someone who interacts with consumers on a day-to-day basis and average people, that if COVID didn't scare people into systematically starting to save more money, if the great financial crisis did not systematically encourage people to save more money, or the inflation we've seen in 2022, nothing is going to. Okay. Now, what I mean by this is you can look at Japan for an example. Okay. Japan's stock market, as we all know, went in a bubble in the 90s. And really what that was consumers in Japan started spending a lot more money, right? What happened? The bubble burst. Times got tough. Japan started saving a lot more money, like the actual citizens. They stopped spending. They started saving. Well, that's a problem for your economy when that happens, okay? And that's why Japan's stock market took like 30 years to hit a new all-time high. Okay, but that was a systemic change in the culture of Japan, going from being more consumption related to less consumption. Okay, I don't think that's ever going to happen in America. Just knowing average people, they're always going to spend all of their money. Okay, in aggregate, like less than 50, like 50% of the population doesn't have $400 to their name. Okay, for an emergency expense. People live paycheck to paycheck in this country. Even if people make more money, like they will still live paycheck to paycheck, right? In aggregate. Why is that important? Because it comes back to the labor market. The only variable that will change consumer spending behaviors is whether or not they are employed. Okay. Now, inflation can also do that, but you have to understand, inflation is a byproduct of money printing. It always is and always will be. Why? Okay. Inflation is not supply chains. Inflation is not the Fed. Inflation is the government. It is money printing and giving out free money. Okay. That is inflation. Okay. Why? Well, imagine it like this. If you make the same amount of money this year, next year, the year after that, blah, 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 and let's say a month from now, your, $5 bag of Doritos that you love to buy, you have to have them, you always want them, right? Goes to $7. Okay. You will still buy that bag of Doritos, but less often. So from a company perspective, raising prices really just destroys demand in an environment where the money supply is stable and call it stagnant, right? Wages are stable. In an environment where, let's say, the bag of Doritos goes to $7, and maybe normally you get $500 a week on your paycheck, but in a month from now, you get $700 on your paycheck. That $7 bag of Doritos doesn't feel as bad anymore. Okay, so it's called demand destruction. You can read into this if you would like, but the more companies raise prices without the offset of more money out in the economy and more money in consumers' pockets, the more demand destruction you will see. Every cent, every dollar, every $10 a product is raised, you will see demand destruction. Okay? If it's not offset by more money supply. Okay? That is why inflation is always a monetary phenomena. Okay? It always has to do with the money supply. Nothing else. Because if prices just go up in stores and nobody has any more money, people are going to not buy as much. And then companies are going to have to idle factories and then lay people off. It's like, would you rather eat a little bit of inflationary, impacts, tariffs, whatever taxes in the margin, or raise those costs, pass it on to your consumer, probably lose market share to someone who doesn't need to do that, sell less as far as units, and potentially get further behind your competition? No. Okay. So I could probably make a 30-minute long video on this. Long story short, we're not going to see this inflation that people are predicting. Wall Street will have to get more bullish on stocks, and markets will move higher. That's my thought. That's my view. As long as we don't see some kind of crazy money printing phenomena, stimulus checks, if we start to see that, yeah, all bets are off. Inflation's coming back. Okay. But until we see stimulus checks, free money going out to people, I'm not worried about inflation at all. I think for Tesla stock, and specifically why I'm so bullish, is you can take the same thing that Tom Lee said, the same thing that I just said, and add on to that the thesis specifically with Tesla. Robotaxis coming in June. FSD that has launched in Mexico, in China, soon to launch in Europe. That has done nothing to the bull thesis for Tesla. That's kind of where Wall Street is at. That meant nothing. Okay. It obviously does. We're just not in a place where investor sentiment is appreciating that. People are bearish on markets. That's one thing, but they're like double bearish on Tesla. Bearish on markets, bearish on Tesla. It's been an uphill battle for Tesla for sure. Whether it's been Elon's, political affiliation, even Cathie Wood said today there has been some brand damage done to Tesla in the short term, but she doesn't think that is long term. Again, like Wolf of Wall Street says, any bad publicity, good publicity, all publicity is good publicity, right? Even in the book that I read, it's still out in the truck, but it says that if you are a company and 80% of people, don't like your product, you're still going to be successful. Because if 20% of people love your product, it's all that matters. You don't have to win everyone over. From the whole brand damage thing, I've never really thought that mattered for Tesla. And I still think there's a lot of people from the Wall Street community that are concerned about brand damage, that are concerned about slowing sales, that are concerned about Elon's political, views. They're not thinking about robotaxi. They're not thinking about continued expansion of FSD. And even now in China, like FSD is not, it's not like it is in the US, right? It's still not able to be used everywhere like in the US. Once that continues to open up, which we should have regulatory approval for like city streets and day-to-day traffic in China here in the next couple of weeks, I think that's going to be a big catalyst to get more people in China to buy Teslas. Wall Street is also not really considering the push from the United States government to the Chinese government to get their consumers to spend more. The brands that already have a presence in China from, American companies are going to be the ones that really benefit the most from that. So there's three big positives right there. Wall Street's really not even considering. Optimus, I think over the next 6 months is going to be big talk. Okay. Tesla's obviously making a lot of advancements in AI as just a general one. Energy storage continues to go crazy. Tesla just literally bought a new factory to convert into a megapack factory, like super cheap. What was it, like 40 million? Something stupid cheap. I don't even remember the exact number. Really cheap. That's going to be able to do 10,000 units a year, right? So that's now 3 megapack factories. Well, 2 technically right now. The Shanghai one just finished as well. Nobody's talking about this. Until people really start talking about this from an analyst perspective, it's not priced into the stock. Okay. So all of those things I just mentioned are like, it's not even insider info, although it kind of feels like it. It's like, hey, you have a heads up of this. Inevitably, Wall Street's going to pick up on it, and then the stock's going to react to it. It's like I'm giving you a heads up. I don't know how far of a heads up. It could be a 2-week heads up. It could be a 2-month heads up. It could be a 6-month heads up. Not exactly sure. But these things, when Wall Street realizes what's going on in Tesla, that's going to drive the next 6 months of Tesla's rally, I believe, which could easily send Tesla to be a $600 plus stock by the end of this year, which would be around a $2 trillion valuation, right? I believe technically $2 trillion is around like 640 or so on Tesla, which, 600 or so, high 500s, does it really matter by the end of this year is kind of where I'm expecting. Now, I also believe in the event that we do not see inflation, what's going to happen? Bond yields are going to come down, the Fed's going to cut rates, and you're going to see your high beta, high growth stocks really outperform, and that's Tesla. Again, the next 6 months, that is my expectation. So add all of this together, I think it's really hard to come to a logical bear case. Like, I couldn't come to a bear case on Tesla without the labor market dramatically weakening. And at this point, I don't see that. That is very unlikely, in my opinion, at this point, unless something dramatic shifts in trade policy. Like if we go back to April 2nd tariff levels, of course, like depression is on. Hyperinflation is on. What are the odds of that? They're very low. Very, very low. Like less than 1%, I believe, at this point. That's not something I would want to bet on. Maybe have some YOLO puts, for the end of this year. Maybe crazy like YOLO puts. Couple $100 on those, depending on your size of your portfolio. Like less than 1% of the portfolio could make sense, but is it even worth it? Like probably not. So, with the whole bigger picture here, I think you're crazy if you're bearish on stocks. I just don't see it, right? I just don't see it. And usually I'm the guy that's like, okay, usually I'm like the bear 50% of the time. Wall Street's super bullish and I'm the bear. Now I'm like, how are people this bearish? It just doesn't make any sense to me. So let me know your thoughts down below in the comment section. Ladies and gentlemen, I didn't even mention deregulation, lower taxes. Add that to it. Yeah, just add that to the bull case, if you will. So let me know your thoughts on this down below in the comment section. Have a great rest of your day, and I will see you in the next one.